close everything else. Right now. Because the number on your screen, the one your broker is feeding you for silver, isn't real anymore. It's a computer-generated hallucination coming out of New York, and it just lost all contact with what's actually happening on the ground. While your screen says $85 per ounce, physical buyers in Shanghai just closed at 93.31s. Not last month, not some future projection. Today, January 12th, 2026. That's an 8.31 gap between what the system says silver costs and what people are actually paying to get it. In any functioning market, that spread dies in minutes. Every arbitrage desk on Earth would buy at $85, fly it east, sell at $93, and pocket $8 per ounce risk-free. They'd collapse that gap before lunch. But the gap isn't collapsing, it's widening. And the reason it's widening is the single most important thing happening in metals right now. The arbitrage is dead. The bridge connecting east and west has been destroyed. The metal that used to flow between these markets isn't flowing anymore because there's no metal left to move. This is the day the paper market dies. This is the day the system fractures. You're watching it happen. Let me show you exactly what happened today, because the numbers coming out of China are beyond anything we've seen. Shanghai trades silver in 2 sessions, morning and afternoon. This morning closed at $91.13. Already massive, already well above US pricing. But then the afternoon session opened and something snapped. Buying pressure was overwhelming. Not retail panic, industrial procurement, strategic orders, corporate buyers sweeping the order book at any price. By close, the price had ripped to 93.31. That's a $2.18 move in one afternoon. That's the kind of move you see when a government loses control of its bond market. Except this isn't a bond. This is a physical metal. And when a physical metal moves $2 in an afternoon, it means the buyers are desperate. Now compare that to what happened in the US today. COMEX spot silver closed around $85. The exact number doesn't matter. What matters is this. The US market is trading at least $8 below the Chinese market. That's not a premium. That's a chasm. In commodities, an $8 spread on a fungible asset like silver is a market failure. It means the two markets are no longer connected. It means price discovery is broken. It means we're not trading in one global silver market anymore. We're trading in 2 separate markets with no relationship to each other. And the most terrifying part, the gap isn't narrowing, it's expanding. 2 weeks ago, when we first tracked this after China's export licensing went live January 1st, the spread was around $5. Last week it grew to $7. Today it hit 8.31s. What does that tell you? The pressure is building, not releasing. Every day that passes, Chinese buyers are willing to pay more and more above the Western price. They're not waiting for convergence. They're front-running the inevitable breakdown of the Western market. Why are they paying $93 when spot is $85? Because they know spot is irrelevant. Spot is the price of a paper promise. Spot is what you pay for a futures contract that might or might not deliver metal in 3 months. But the Shanghai price is the price of real physical bars you can touch, load onto a truck, drive to your factory. And in a world where the vaults are empty, where delivery failures are piling up, the physical price is the only price that matters. When I tell you silver hit $93 in China today, I'm not telling you about a rally. I'm telling you about a repricing. The market is finally discovering the true value of scarce physical metal in a world that desperately needs it. This brings us to the question everyone is asking. Why can't the arbitrage traders close the gap? Why aren't the banks buying in New York and selling in Shanghai? Because there's no silver to move. Arbitrage requires 2 things. First, price divergence. We have that. The spread is $8. Second, available supply. You need to be able to actually buy the metal in the cheap market and ship it to the expensive market. And that's where the system is breaking. Because when the banks try to buy physical silver in New York, when they try to stand for delivery on COMEX, when they try to source bars from dealers, when they try to pull metal out of the vaults, They're discovering the metal isn't there. Registered inventory at COMEX is down to around 30 million ounces. That sounds like a lot until you realize open interest, the total number of paper claims on silver, represents hundreds of millions of ounces. The metal that's supposed to back those paper claims doesn't exist. It's been drained. It's been pulled by the smart money who saw this months ago. And even if a bank could find silver in New York, they can't ship it to China because of the export licensing system. Once metal crosses the border into China, it's trapped. It can't come back out. The Chinese government has created a one-way valve. Silver flows in. It doesn't flow out. The arbitrage isn't just difficult, it's impossible. The bridge has been destroyed. The two markets are now floating free, completely disconnected. This is the bifurcation we've been warning about. Today is the day it became undeniable. Now you're thinking, okay, so the Chinese are paying a premium. Why does that affect me? I buy my silver in the United States. Because what's happening in China today is a preview of what's about to happen here. The Chinese market is the leading indicator. It's the canary in the coal mine. And the canary just died. When Chinese buyers are willing to pay $93 while the paper market says $85, it tells you the paper market is mispricing the asset by $8. And eventually the paper market has to correct. It has to catch up to reality. How does it catch up? Through a delivery squeeze? Through a default? Through a force majeure declaration? Through one of a dozen mechanisms that all result in the same outcome? The paper price explodes upward to meet the physical price. And when that happens in New York, when COMEX is forced to admit it can't deliver the metal being demanded, the US price isn't going to drift up slowly from $85 to $93. It's going to gap. It's going to open at $95 or $100 overnight. Because once the illusion of the paper market is shattered, the real price is revealed. And the real price is whatever the desperate buyers are willing to pay. The Shanghai price today isn't just a foreign market anomaly. It's a prophecy. It's showing you exactly where the US price is headed, and it's giving you a very narrow window to prepare. But the Shanghai price is just one piece. Because while I was watching the Chinese market go vertical today, I was making phone calls. I was talking to people inside the physical silver industry in the United States, and what they told me should terrify every person watching this. I spoke to executives at major bullion dealers, not small coin shops, the largest dealers in the country, the ones who supply the retail market, the ones with relationships at the mints and refineries, and they told me point blank, nobody has any silver. Those were the exact words. Nobody has any silver. The premiums, the amount you have to pay above spot to actually get physical metal, exploded today. Premiums that were $5 last week are now $8 to $9, and that's just the starting point for negotiation. One executive told me, and I'm quoting directly, silver round premiums could go to $20 to $30 per ounce here. $20 to $30 on top of an $85 spot price. That would put the real cost of buying a silver round at $105 to $115. And he wasn't speculating. He wasn't exaggerating. He was looking at his inventory sheets and his order backlog and telling me what the math says. Because here's the reality. The private mints that produce silver rounds and bars for the retail market are completely overwhelmed. The orders they've received in the last 2 weeks exceed anything they saw in the 2020 silver squeeze. And back then, they ramped up production and caught up within a few months. But this time is different. This time, they can't get the raw material. The refineries aren't selling to them. The refineries are prioritizing contracts with industrial users, Tesla, Apple, solar panel manufacturers. The mints are at the back of the line, so delays are exploding. If you order a silver round from a private mint today, you're looking at an 8-week delay, 2 months. And that's assuming the mint doesn't run out of silver entirely and refund your order. Think about what that means. If you want physical silver right now, you have 2 options. Option 1, buy from a dealer who has inventory and pay an insane premium. Option 2, place an order with a mint, wait 2 months, and hope they can actually fulfill it. Neither option is good, but option 2 is gambling. You're betting the system holds together for 8 more weeks. You're betting the mint can source the silver. You're betting the price doesn't explode to $150 while you're waiting. If you want silver, you're going to pay the premium. There's no other choice. The spot price on your screen is a fantasy. The real price, the price you actually pay to get metal, is already pushing $100. This brings us to an uncomfortable truth most investors don't want to face. The price you see on TV is not the price of silver. It's the price of a derivative of silver. It's the price of a futures contract. It's the price of an ETF share. It's the price of a paper promise. But when you try to convert that paper promise into actual metal, you discover the conversion rate isn't 1-to-1. You discover the paper says $85, but the metal costs $100. This is the paper to physical premium, and it's exploding right now. Why are the premiums so high? Because the dealers aren't stupid. They see the same data we see. They see the Shanghai price. They see the delivery failures. They see the COMEX inventory drain. And they're pricing in the future. They know the silver in their vault today is going to be worth a lot more next month. So why would they sell it to you cheap? They're holding out for the higher price. They're rationing inventory. They're waiting for spot to catch up to physical reality. And when spot does catch up, when COMEX finally admits the paper market is broken, the dealers who held their inventory are going to make a fortune. They're going to sell their silver at $120 or $150. But the investors who waited, who believed the spot price, who thought they could buy the dip when silver pulled back to $75, those investors are going to be left with nothing. Because by the time they try to buy, the metal will be gone. This is the supply shock we've been warning about. And it's here. Not next year, not next month, here, today. Now let's zoom out and talk about what this means for the broader financial markets. Because the silver squeeze isn't happening in isolation. It's happening at the exact same time as a historic move in gold. Gold hit an all-time high today, somewhere north of $2,600 per ounce. That's a massive breakout. That's gold screaming something is very wrong with the global financial system. And when gold and silver both rip to all-time highs simultaneously, it's not a coincidence. It's not just a commodity rally. It's a signal. It's the market voting with billions of dollars that the fiat currency system is failing. Here's the part most people don't understand. When gold and silver go vertical like this, they don't just compete with stocks for investor dollars. They do something much more destructive. They create a liquidity black hole. The entire global financial system is built on a foundation of risk-free assets. At the base of the pyramid, you have U.S. Treasury bonds, considered the safest assets in the world. They pay a guaranteed interest rate, and that rate is used to value everything else. If a treasury pays 4% and a stock has to compete with that bond for investor money, the stock has to offer a higher return to justify the risk. This is the risk premium. Every stock, every corporate bond, every piece of real estate is valued relative to the treasury rate. But what happens when gold and silver, the ultimate risk-off assets, start outperforming treasuries by a massive margin? What happens when gold is up 30% in a year and silver is up 170%, while treasuries are losing money because yields are rising and prices are falling? It breaks the model. Investors look at that and say, wait, why am I holding treasuries that pay me 4% and lose value when I could hold gold that pays me nothing but goes up 30%? And they sell the treasuries. They sell the bonds. They move into hard assets. When treasury prices fall, yields rise. When yields rise, borrowing costs rise. When borrowing costs rise, companies cut spending, consumers cut spending, the economy slows. But more importantly, the valuation models for stocks break. Because stocks are valued on discounted cash flows. You take future earnings and discount them back to the present using the risk-free rate. But if the risk-free rate is rising, the present value of those future earnings falls. So even if a company makes the same money, its stock price has to fall to reflect the higher discount rate. This is why gold and silver going vertical is so dangerous for the stock market. It's not just about money flowing out of stocks into metals. It's about the entire valuation framework of the stock market collapsing. And we've seen this before, 3 times in recent history: 2000, 2007, 2019. Every single time, gold and silver surged to new highs, treasuries sold off, and within 6 months, a massive recession hit. In 2000, it was the dot-com crash. In 2007, it was the housing bubble bursting. In 2019, it was the repo crisis that led directly into the COVID crash. And now in 2026, we're seeing the same signals. Gold and silver at all-time highs, treasuries under pressure, and a Federal Reserve that's completely trapped. Which brings us to the elephant in the room, Jerome Powell. As I was preparing this, news broke that there's a criminal probe into Federal Reserve Chairman Jerome Powell. The probe is related to concerns about Federal Reserve independence and potential conflicts of interest. I'm not going to speculate on the details. I'm not a lawyer. I don't have inside information. But what I can tell you is this: the fact that the chairman of the Federal Reserve is under criminal investigation at the exact moment the financial markets are falling apart is not a coincidence. The Fed is losing credibility. The market is losing confidence. And when the market loses confidence in the central bank, bad things happen very quickly. Let me explain the trap Powell and the Fed are in right now. They have 2 choices, only 2, and both lead to disaster. Choice 1, print money, lower interest rates, restart quantitative easing, inject liquidity to prevent a deflationary collapse. This saves the stock market short term. It prevents a recession. It keeps the banks alive, but it destroys the currency. It causes inflation to spiral out of control. And it sends gold and silver vertical, because every dollar the Fed prints makes hard assets more valuable. If they choose this path, silver doesn't stop at $100. It goes to $150, $200, maybe higher. Choice 2, don't print. Hold rates high. Let the bad debts fail. Let the zombie companies go bankrupt. Let the housing market crash. This restores discipline to the financial system. It purges the excesses. It sets the stage for healthy recovery. But it causes a depression. The stock market crashes. Unemployment skyrockets. Credit markets freeze. The banks fail. If they choose this path, silver might dip short-term because of deflationary panic. But it will surge even higher long-term because the system will have lost all credibility. The dollar will be finished. People will flee into hard assets as the only remaining store of value. The Fed is trapped. They can't print without destroying the currency. They can't not print without destroying the economy. And the market knows this. The market sees Powell is under investigation. The market sees the Fed has lost control. And the market is voting with its feet. It's exiting the dollar. It's exiting treasuries. It's piling into gold and silver. This is the confidence crisis we've been warning about. And it's accelerating. Now let me bring this back to the silver market specifically, because the Fed's trap has direct impact on the price of silver. If the Fed prints, silver goes vertical because of currency debasement. If the Fed doesn't print, silver goes vertical because of flight to safety and industrial shortage. Either way, silver wins. This is why silver is the most asymmetric trade on the planet right now. You're not betting on one outcome. You're betting on a range of outcomes that all lead to the same result: higher prices. The only scenario where silver goes down is if the Fed somehow threads the needle perfectly, prints just enough to avoid a crash but not so much it causes inflation, and then somehow a bunch of new silver mines come online and flood the market with supply. What are the odds of that? Close to 0. The risk-reward is massively skewed in favor of the silver holder. Your downside is maybe 10 or 15% if there's a short-term panic. Your upside is 100% or more. That's an asymmetric bet. And asymmetric bets are the only bets worth taking. But here's the critical point. The window to take that bet is closing rapidly. 2 weeks ago, you could buy silver at $75. Last week, you could buy it at $80 with a small premium. Today you're paying $85 spot plus an $8 or $9 premium, so you're at $93 or $94 all in. Next week you might be paying $105. The week after that you might not be able to buy it at all because the dealers will be sold out. This is the escalator effect. The price is going up one step at a time, and every time you hesitate, every time you say, "I'll wait for a pullback," the escalator moves up another step. Eventually, you look up and realize you're 10 floors behind. If you've been waiting for the perfect entry point, I have bad news. The perfect entry point was 2 years ago at $20. The good entry point was 6 months ago at $30. The acceptable entry point was 2 weeks ago at $75. Today at $93 to $94 all in is still reasonable if you believe the thesis, but it's not perfect, and it's getting worse every day. So you have to ask yourself, do I believe silver is going to $150 or $200? If the answer is yes, then paying $94 today is fine. You're buying at a 50% discount to the future price. But if you hesitate, if you wait for a dip that never comes, you're going to be the person who watches silver hit $200 and thinks, "I should have bought at $94. Don't be that person. Make the decision now. Now let's talk about the mechanics of how you should be buying silver in this environment. Because the strategy that worked 6 months ago doesn't work anymore. 6 months ago, you could buy an ETF like SLV and feel relatively safe. The ETF tracked the price, you got your exposure, you could sell whenever you wanted, liquid, convenient. Today, buying SLV is a gamble, because SLV is backed by physical silver held in a vault by JP Morgan, and we don't know if that silver actually exists. We know JP Morgan has a private hoard of 750 million ounces, but we don't know if they're using that hoard to back the ETF or keeping it for themselves. And more importantly, the SLV prospectus has a clause that allows the custodian to cash settle in the event of market disruption. So if COMEX breaks, if the delivery system fails, if the vaults are empty, SLV can just give you cash instead of silver. And what good is cash if silver is trading at $150 and you get paid $85? SLV is a risk. In an environment where the physical market is breaking, I don't recommend taking that risk. The safer option is PSLV, the Sprott Physical Silver Trust. PSLV is domiciled in Canada. It stores silver at the Royal Canadian Mint. It allows physical redemption if you hold a large enough position. It has a more transparent auditing process than SLV. Is PSLV perfect? No. But it's better than SLV. The best option, of course, is physical silver in your possession. Coins, bars, rounds stored in a safe in your home or in a private vault you control. Yes, you'll pay a premium. Yes, you'll deal with storage and security. But you'll actually own the asset. And in a world where paper markets are failing, ownership is everything. If you're buying silver today, buy physical. Pay the premium. Deal with the inconvenience. Because the inconvenience today is going to save you from the catastrophe tomorrow. And if you can't afford physical, if the premiums are too high, then at least buy PSLV instead of SLV. Give yourself a fighting chance. But whatever you do, don't sit in cash. Don't sit in treasuries. Don't sit in a money market fund earning 4% while the world burns around you. Because the Shanghai price today, 93.31, is a warning. It's a signal the paper market is dying. It's a signal the physical market is the only market that matters. And the gap between the two is going to keep widening until the paper market finally breaks completely. Now let me give you the timeline as I see it. Because people always ask, when is this going to happen? When is COMEX going to break? When is silver going to $150? I don't have a crystal ball. But based on the data, based on the Shanghai premium, based on dealer inventories, I believe we're looking at weeks. The delivery notices for January are going to be released soon. If they show a spike in demand, if they show a large number of contracts standing for delivery, it will trigger a panic. The market will realize COMEX doesn't have the metal to deliver. And once that realization sets in, the price will gap up violently. I'm talking about a $10 or $15 gap in a single trading session. Silver opening at $100 on a Tuesday morning because something broke over the weekend. And when that happens, the premiums on physical metal are going to explode even further. Dealers will charge $20 or $30 over spot. Mints will stop taking orders. The retail market will effectively shut down. And if you don't have your silver by that point, you're not getting it. You'll be stuck watching the price go to $150, $200, knowing you could have bought at $94 if you had just acted. The time to act is now, not tomorrow, not next week. Now. This is your Lehman Brothers moment. But instead of a bank collapsing, it's a commodity market collapsing. And the Fed can't save it by printing more dollars, because you can't print silver. The Shanghai price today, 93.31, is the smoking gun. It's proof the system is broken. It's proof the arbitrage is dead. It's proof the two markets have split into separate realities. The Western market is living in fantasy. The Eastern market is living in reality. And reality always wins. Get out of the fantasy. Get out of the paper market. Get out of the ETFs that might not deliver. Get out of the futures contracts that might get cash settled. Get into the real. Get into the physical. Get into the metal you can hold in your hand. Because when this system breaks, and it's breaking right now, the people who own physical silver are going to be the winners, and the people who own paper promises are going to be the losers. The choice is yours, but the clock is ticking. Shanghai just hit $93. The US price is at $85. The gap is $8 and widening. How much wider does it have to get before you realize the paper price is a lie?